coming from multifamily here, I'm like, okay, you know what? I know for a matter of fact that it is maintenance expenses that kind of like tears everything up, and you can really go over budget in maintenance expensive. Then coming to storage, I'm seeing that the maintenance expenses were really, really, really low.
Yeah.
And all. So with multifamily, HVAC always broken.
Yeah.
Problems with
Yep.
plumbing,
Yep.
problem with electricity, and
Yep.
stuff like that. But in storage, you get very, very minimal of that. And the kind of expenses that you see that will be higher in storage some of the time in some facilities compared to multifamily will be like maybe junk removal fees, which will be kind of lower in multifamily. So that was kind of different to see. And even landscape, like in multifamily, you have a lot of landscaping, which costs a lot of money. Yeah. But in storage, most of that land is already built. Mm-hmm. So that's some areas I saw that was different.
When you guys are looking at property management software for your storage facilities, there's a ton of options out there, but no other option compares to Tenant Inc. Tenant Inc. is going to be your one-stop shop solution that has an amazing amount of tools that you can deploy at your fingertips to maximize the value of your facility, to operate it more efficiently, more effectively. They have an open API where you can back in almost anything you want. You own your data, and it's just an incredible solution. I can't say enough good things about these guys. Link is in the show notes. Be sure to check out Tenant Inc.
Welcome everybody to Self-Storage Income. And today I am so excited to have Maryanne with us. How are you doing?
I'm doing great. Thank you.
Well,
how are
thank
you?
Doing awesome.
Yeah.
So we have been so fortunate to have you join our team, and you come with a background in asset management, and in particular you came from multifamily. And asset management is a big thing for us, especially how we're vertically integrated and looking at those in a separate control almost piece for our facilities and communications. And this was a piece that we really felt in our organization for a while was missing. And so you came in from scratch. We did not have an asset management department. We didn't have anything on that end, because asset management to us was almost just property management and the private equity side, which it really is not, right? That's not totally their job functions or whatnot. So you had to step in. Yes. And basically kind of been creating it and learning what we do and how we do it. So you get to see a lot within our business and self-storage.
Yes. So I have over 20 years of multifamily property management experience, and I've just been in storage for about 4 months, and it's been so different. So I came and thinking that, real estate is one and the same, but it's not. So it's really so interesting learning the differences and also really helping the team and see where we can improve. And that has been so exciting.
Yes.
So exciting.
And we have a lot, it's so interesting, your perspective and bringing it in and looking at it, because it completely changes a lot of the overall conversations we have and how we look at it, because you're not coming from a position of like, well, I'm in this department and I think we should do this or have this work. It's like, no, we're just simply looking at the asset overall, right? And I'm not tied in with any of these things. And you get to work with the companies on the outside and really bring up things that we may not even be seeing. And
the total fishbowl effect, where you can really be outside of it, looking in and saying, hey, let's do this, let's do that, and really help guide those conversations and ask some of those questions. And we might have, like AJ's talking about, we might have biases, we might have assumptions about things because we've had certain experiences in the past, but then having somebody come in and like test those, like, are you sure? Like, are you sure that's how that works, or how we should be doing that thing? So it's fantastic having that outside perspective coming in, asking the questions, poking the holes in the plans, and making sure that all the bases are covered. And we are squeezing as much juice out of these things as we possibly can.
I think one key area is like the key performance KPIs, right? And all for the different facilities, and like looking at where the occupancy is for each facility and why. And for those facilities that are doing great, how come you're doing greater than another one and everything? So trying to compare facilities and also what is causing these trends and all. So that has been very, very interesting to see and everything, having like a pulse on everything. So occupancy and rental income and expense ratios. And it's so interesting to see why one facility's expense ratio could be higher than another.
Yeah.
You know? And again, coming from multifamily, the like kind of expenses are pretty much the same. But for storage, like having like a temperature controlled facility will have different like expenses than one that is not temperature controlled. And also, so that's really like some key things that I'm looking at and trying to figure out, and also budgeting for these facilities too, looking at just everything in general and making sure that we have positive NOIs and all. It's really cool to see.
Yeah. So why don't you, a lot of people may not even really, they don't either have asset management, as in they don't have an actual role, right, an actual department. So why don't you give people an idea of what it is that you do, first of all, what they can do, what we should be doing. And so what is asset management? Because it's not property management, right? It's not private equity. What does that involve? What does your job and role within the organization do and involve?
Okay, so my role is to make sure that the facilities are performing and everything, and to quickly identify red flags, right? So if there's any way that we're missing on some points, to quickly identify that and correct it. And the only way to do this is like looking at trends. How are we doing? How are we performing? Occupancy. Check week after week. Are we increasing in occupancy? If we're reducing week after week, we need to figure out what is going on in there. And except someone like me is checking that week after week, we can miss it and just kind of like, oh, this property is doing well, but when it's actually not doing well. And also, figuring out occupancy and how that is trending, that is key. And some of the time, like if like occupancy is reducing, it could be because of some elements that is beyond our control. Some of the time, like there's some months like towards like the fall period where occupancy starts to reduce. It's just the trend year over year. People move out more than people move in, so we can expect some reduction in occupancy at that point. So like checking occupancies are one of the things I do. Then expense ratios, right? And everything, checking out our expenses and where we at, what are we spending money on and all. And trying to like really make that not tight, but like be conservative and all, and just don't spend too much where you don't have to. Make sure that you're spending according to the budget and all, because watching the NOI is super important to the value of the property. So checking those expense ratios in comparison to the budget or the pro forma is super key. So I do check that. And also things I check is like the rent. So what are the rent of this unit types as well, and or compared to what's in the market, because that would actually help with moving people in. Checking sell rates compared to in-place rates as well and all. So if, for example, we have unit types like 10 by 10s and you have like maybe 20 of them that you have to fill, what is the competition leasing those for and all? You want to check, are you comparable to the market or you're not? Some of the time maybe you're overpriced and you want to reduce it. And stuff like that is some of the things that I checked as well. Then
I think you brought up so many good points here. And one of the things that I really like that you said, because it's really important, is to not just report, but you want to understand why, right? So, okay, hold on. Is this in our control? Is it out of our control? But two, a lot of times, why is it occurring? So I think it's so easy for people to just say, it's the market. And I hate doing that because we immediately give up control. And I hate it. I don't like accepting things the way they are. So even if it is the market, then how do we change it? But when you're looking at these trends, like you mentioned, sometimes that correlation you think's obvious, but it's not. Perfect example of that would be occupancy. Occupancy's high. That means we're doing well. Well, okay, but why is revenue dropping? Right? And that actually happened. So like we had a facility that we were in fill-up mode, right? So you're in fill-up mode, all of a sudden we start giving discounts, everything else. Occupancy was going up, but we weren't seeing a corresponding rise in revenue. And obviously that's because we were trying to fill it up, and then we would do revenue management afterwards. But really digging into these trends, why, and you mentioned, why is this one successful? And why is this one struggling in this area? What can we learn? How can we apply it? And diagnosing performance more than even just reporting it.
Exactly. And then there's so many other factors like to look at when you're trying to diagnose issues with like occupancy and all. You want to look at like your unit types. We've seen like maybe in a facility, like maybe the 10 by 20s are moving much faster than the 10 by 5s and all. We're seeing that like maybe people in that demographic, that area just need bigger spaces. So being able to like look at and see that, oh, the 10 by 5s are smaller. Maybe we should like remove some walls and make them bigger so we can like lease up these ones. So stuff like that is things that we have to like first analyze it and everything and be able to like make decisions on how to like move occupancy and stuff like so. It's super important.
And it too, this is an issue that like we were talking even before we got on the podcast here, how a lot of people didn't ever spend any time diagnosing things because there was nothing to diagnose. Everybody was full, rents were raising. So a lot of people didn't even know, okay, we're giving rental rate increases, but should you have been giving more or less? And you didn't need to worry about it because there was no vacancy. So it was just everybody's full, everybody's rising rates. And so nobody took the time, right? Nobody actually looked to solve those problems, which was very different than when we got started. It was, no, the average occupancy is, 80%. And so it was everything we had to look at and we had to figure out, well, is this working? Is that not working? Right. And I think a lot of people got out of this asset management habit of the diagnosing part to understand, especially when markets are changing. That's really, really important. And it's just something I think that the industry in general had put either to a back burner or forgot completely about.
Well, and I think you put it really good, AJ, as you said that, there might be those uncontrollables like the markets that happen. But again, like you said, how do you respond to those things?
Yes.
Because it's not like you can just throw your hands in the air and be like, no, I don't know what to do. There's nothing I can do. It's like, no, you have to do something.
You have to do something.
And what is that? And one of those things that I love that you'd shared with me at one point, Maryanne, was was it the 4 Ps
Correct,
that you went through? Do you want to go through that really quick? Is how you jump in, diagnose, and ensure that the asset and the product type and the customer and those different things are good.
Yeah. Okay. Sounds good. Let me share that with you. So the 4 Ps, that is price, product, promotion, and people. Is so if there's a red flag with occupancy, I always go through my 4 Ps to kind of diagnose and see what the issues are. So price, what are the price compared to the price out there, the competition's price? Are we in line? Are we not in line? Should we be dropping rates and all? So that is important. Then the products, as I mentioned, 10 by 10s, 10 by 5s, which one is moving, which one is not? Is it on the second floor? Is it on the first floor? What's the curb appeal like? Are your fences broken? Are they not broken? When people walk through your facilities, what do they see? Is it attractive? So we're talking about the product here. And just it's different from multifamily in a little bit because with storage, there's so many levers you can pull and everything, which is kind of very different from multifamily. So with product, just to know what it is that you're selling, how many of it you have available, which is moving, which is not moving, how can you move things around and all. Promotion is another key one. How are you advertising? Where are you advertising? What pictures do you have out there? And or how are people finding you? Are your phones working? And stuff like that. And where you're advertising, like your competition, are they also advertising on the same platform? Do they see your prices when they see theirs and all? And how is that comparing to each other? Super important. Then the last thing is the people, like the person in place, the manager, super important. Customer service, right? And everything. I know I'll pay more for somebody that has like manager that has great customer service. How receptive are they? What kind of concessions are they willing to give for me and all? And again, is a manager that would know like the price out there, or are my promotions okay, or are my phones ringing less and everything? So people kind of ties everything together. Who you have in place managing these places. So those are the 4 Ps in a nutshell.
I love it. I love how you walk through and you line item and say, okay, what's happening here on this end? And a lot of times, because they are obviously interconnected, so one thing can cause a chain reaction of failures. We've seen, and a lot of people see, you have a problem with your listing. Well, then all of a sudden you may be giving promotions, and the promotions aren't working, and you're discounting promotions, but then you looked at your advertisements to find that the listing wasn't working. So it wasn't even the fact that the promotions weren't right or even the market was bad. It was just one thing was kind of broken. And when you start to look at those things as a connected chain, you find, all right, we have the product, right? We have the people, we have all this. Where in this lineup is something not connecting? Where is something broken that's now causing these issues?
Yeah, I mean, because you can't throw the baby out with the bathwater, right? Especially, and you can't just start pulling all the levers like you're talking about, not knowing exactly what's going on. And like we've seen, I mean, there's been a number of times where we've identified an issue, we'll jump in and we find that broken piece, we can jump in, we can fix it, get it taken care of, and move forward. And then we automatically will see that increase. We've seen it in occupancies. You know, when we've gone in and done some aggressive rate management, we've seen that increase in occupancy take place because the product, the people, all the other factors were good, right? So
exactly.
When it comes to designing your self-storage facility, it is so imperative that you capitalize on the square footage and the efficiency of the facility as best as possible. You don't want to have to start redesigning a facility way down the development process. You want it right from the get-go. And that is what we're here to help you guys with. Follow the link below in the show notes, get in touch with us, and our in-house architect can start working with you today.
And now, we've talked about, and you mentioned, I'd love to even dive into this more. What were the main differences between multifamily and doing asset management in that and moving over to storage? What are those main differences that you've seen that stood out to you? I mean, both good and bad, but.
Okay, I would say number one on the expense side, and all coming from multifamily here, I'm like, okay, you know what? I know for a matter of fact that it is maintenance expenses that kind of like tears everything up, and you can really go over budget in maintenance expenses. Then coming to storage, I'm seeing that the maintenance expenses were really, really, really low, and all. So with multifamily, you know, HVAC always broken, problems with plumbing, problem with electricity, and you know, stuff like that. But in storage, you get very, very minimal of that. And the kind of expenses that you will see that will be higher in storage some of the time in some facilities compared to multifamily will be like maybe junk removal fees, which will be kind of lower in multifamily. So that was kind of different to see. And even landscape, like in multifamily, you have a lot of landscaping, which costs a lot of money. But in storage, most of that land is already built. And also snow removal, sorry, not snow removal, but landscape like mowing is less. Yeah, snow removal can be maybe higher or like pretty much the same. So that's some areas I saw that was different. And also when it comes to rent increases, like in-place rents and just rent increase in general, in multifamily, we usually would look at the loss to lease. So we'll compare the rent the tenant is currently paying and the rent that they would get like a 2 bedroom for out there in the market. And usually the tenant is paying less than what is out there. So there's a loss to lease, right? And everything. It could be like, $300 and $400. Like even right after COVID, it went up to like maybe $600 for some people that were getting such high raises and all. But in storage, when I kind of went to use that same formula here, it didn't work, right? Because the sell rate, how much you're seeing units listed, was so much lower than the tenants are paying and all. So what it is like the rents, the sell rate is lower. So I'm after they have moved in, you can then do like rent adjustments or rent increases. So you couldn't really do like a loss to lease at that point unless you be giving people back money and all. So somebody moves in, maybe they have a 10 by 20 and they were paying like $150 or $200 for their 10 by 20, right? And all. But because the market has changed somehow, those rates have really, really come down to like maybe $70 just to get them in, right? So you're trying to do like rent increase for somebody already paying $200 and everything. And they're going out there thinking that they can get this unit for $70. They can, but it's just that in a few months, it probably will go back up again and all. So trying to find the dynamics of those rent increases and all, and how to really compare and increase, like the in-place rate is so different in multifamily than storage. So those are some like key differences that I've seen so far. I've been doing this just for about 4 months, but yeah.
But I mean, 4 months, but you see everything, because one of the big part of your position that it's just obviously full access to all expenses. You're the only one probably in the organization that is literally working with all components.
Correct. Yeah.
And so you are on the expense, the revenue, you're on the marketing, you are on the overall management, from occupancy, from lease, from you're looking at as well, you're on the maintenance schedules and the cost there. You're looking at the financing. Okay, when do we have our IO? When does that burn off? When do we pay the full interest rate? When do, you're seeing all of it.
Yes.
And it is, you're diving into each one as you're looking at that. And that allows you to really see these trends.
Yes.
And okay, this is working the same way across all of them, but we have some outliers, right? So I think that even just 4 months, you've seen a lot.
Yes.
Yeah, no kidding.
Because too, most of the facilities, I think that it's important to remember that Maryanne's looking at, the vast majority of these facilities are value add assets. So these are assets that we are turning around.
Yes.
They are either high vacancy assets that we bought, or they're underperforming in one way. We have developments. We have, right? So it is the gambit, and these aren't simple straight line facilities that everything is just going fine and cash is coming out, every month. These are they're projects.
Yes. And it's so interesting to see, like, month over month, like when we get a new acquisition, month over month, how those expenses reduce. Like, so when we get it is high vacancy and high expenses. And I am even a little like, a little panic that what is going on here. But month over month, things start to improve. Occupancy starts to improve. Expenses start to reduce, and everything is just like really, even just in a few months, things are looking like really, really good. So it's always so exciting to see, and I just can't wait to like get new projects and just like value adds and increase those facilities and make them very, very.
Yeah, we love it. It's our favorite mode of doing it, and that puts you though into an interesting place, because lots of the times first of all, we may not know. So we may not exactly know all of the, you can never know, no matter how good your due diligence is, all the skeletons in the closet. It's not how it works. If you're not operating in that market with that asset class, you're going to take it over and you're going to learn things. So we have this learning curve with the asset itself. But then not only that, we are changing all of the internal stuff, right? So that onboarding process and the way that we do it, and then we're either being aggressive or not aggressive, and then we're seeing what works and doesn't. So there is that learning process, and okay, let's try this, let's move, the market reacts to this, that we kind of go through. And that's really cool to be able to see, to learn, and to see this is working, but really it's problem solving. Right? And that's what your main job is to look, and even if there's not a problem, to identify and say, this is working good. We should, we should do this over here.
Such an important distinction, because we can get so caught up in identifying what's broken and what's not working and trying to solve those problems, instead of doing that diagnosis on what's actually working.
Yes.
Doing that same thing, like, hey, the promotions are good, the people are good, this is good, that's good. Like going through that same process and being able to take that cookie cutter and apply it to those other assets. And again, I mean, we're in different markets, we're in different areas. The same strategy is not going to work every time, but we can at least take those metrics that we know work and apply them in those other areas to improve.
Absolutely. Now, I think when we look at overall, we have like our storage facilities, right? We take them over. Your job then is to be analyzing, making these larger trends that you're looking at, and you have built a lot of tools to track this, literally from scratch, right? So you're building out, and what Maryanne's building out, we have these large, obviously, spreadsheet that takes all of these inputs that we're looking at. Well, when you're doing that with all this information, which can be overwhelming because there's so much, what are some of the key KPIs that you mentioned earlier that you are putting in, that you're tracking, that are those KPIs are showing you things. What are those that you really focus on?
Okay. First of all, it should be occupancy, right? And everything. So checking the percentage of occupancy for each facility and also watching the trend, right? And everything. So it's important that it's trending upwards and not trending downwards. So checking occupancy is very good. Then expense ratio is another one I check and all. And each facility has like a slightly different expense ratio from another one. And and it could be because maybe of the rental income level or how many units are in the facility. So it does depend. But checking that expense ratio and also checking the trend for that nothing crazy happens and all and everything. So that is super important. Some of the other things I check is delinquency, right? And making sure that we're getting all the monies that we are owed and all. And of course, we have like a percentage that we know that we have to collect by the end of the month, and also making sure that calls are being made and we're collecting all that we're supposed to collect and all is some of the key things that I check, just to check like the health of each facility. It's more of like putting like a pulse, knowing the pulse of each facility, the financial health of each facility, and not dropping the ball and everything. You have to check different things and making sure that everything is working together for the facility to be successful.
And you mentioned something that it's important. I think people should know. You mentioned, every facility is different, and I think that when we look, because of our situation, what we create, an overall outline or business plan with objectives that we're trying to get. So you have your KPIs that you're looking at, and lots of times we're benchmarking that to the expectations. So you actually put out and then you'll put on the side, which we've gone through, and individually. So even though the expense ratios may be different, we've sat down and said, this is what this one should be. And so you're tracking it, and you're also looking through those KPIs at what is the overall outcome that we're trying to achieve, how close are we to that, and if that is diverging from what we want, is it getting better or is it getting worse? And two, having you in on that and understanding that business plan. All right, well, this facility, we are going to have higher expenses for 6 months because we've got to do all this stuff, right? So then that's fine that KPI is higher, right? Now, it may not be our target, but we understand, and that will result in higher revenue. So that's why, why we're doing it. And a lot of people, we talk about this a lot, but making storage a business, right? And approaching it like a business and literally building out a business plan. So what is your business plan for that asset? And then all of a sudden that gives a lot more meaning on those KPIs and what you're trying to achieve and track, because you're benchmarking it to the plan, the goals and the outcomes you're trying to achieve.
Yeah, and very recently we did some like rent increases, and with that we knew that there may be some move outs and everything, 10%, 20%. So like if I was going to look at the trend when those move out happens and I see like a slight drop in occupancy, we can attribute it to the fact that we gave rent increase, but not to the point where we're losing and all, but we're getting those people that are paying like lower rent out to be able to get the people that will be paying higher rent and also.
And you did this. So it's important when you say this, like we actually broke it down. So we have our internal rev management system that is not like our hired out one, but the way that we do, and we have this big spreadsheet, and then what we look at is, okay, predicated on these things, we can have a level that is acceptable and not. So if we had a 10% move out, we're still making X amount more than we would have, even if they stayed. If we had 20%, we're still making more than, we had one facility that we're looking at, it, even if 30% moved out, we're still way better off, right? But then other ones, it may say, okay, after 20%, it actually inverses. The move outs are actually making us make less money than when we win. So we before we even gave those rate increases, you've already mapped that out, and we already know those levels. And then we can look and say, are these rate increases aggressive, so aggressive that we're going to hit those different levels? And then it moves into like a sensitivity. And so that's all taking place, and you're doing that before we even do it. So it's not just, give rate increases and we're going to watch and hope, we're really analyzing that. And that gives you the data and information that you need to then say, okay, we know what we can do here now. Now we can go to a next level of rate increases because now we got that feedback and you understand. We gave these rate increases and we had 5% move out. We actually wanted 15% to move out, right? And so then from there, you can make the changes according to the plan and what you're trying to do.
Right. A couple things on your sheet that's really helpful for me that I know you also map on your data is the income trend and then also the net move-ins, move-outs. So being able to see not only that occupancy and what's happening there, but being able to immediately identify, hey, we're having net negative move-outs in this facility, or that facility has been super helpful for us. And then those other metrics you talked about.
We track that weekly.
Yeah, exactly right, on a weekly basis. And then, like you guys are talking about, just getting granular with the unit types in these facilities and driving not just the rates and the standard increases as per normal, but what can you do outside of that to push those rates to drive that revenue even more.
Well, and that's another thing she does because she breaks it out for us on unit, like, okay, that vacancy, where is it? So like Connor is saying, it's specific to unit type, which, I have a YouTube video you guys, I think, could check out because I actually show what you've done. And I actually show Maryanne's report on there because it shows our facility. And we said this facility has, it's a fill up facility. We have 40%, vacancy in it. But then if you go that next level, that vacancy, 70% of that vacancy is in one unit size. And that's generally what we see. So even if it's 10% vacancy or 15, 20, it doesn't matter the vacancy, it's usually concentrated in 1, 2, maybe 3 sizes will be the vast majority, if not all of it. Then the other sizes have just no vacancy. That alone, what that tells us and what that creates a plan. So then what Maryanne can do, she takes that and says, now let's look at rate increases. Now we know sensitivity. So now we know here's the 3 sizes where all the vacancy is, but here's the 6 sizes that are good that don't have any. And so now that's why when we say Maryanne's targeting to hedge against that vacancy, right? It's we can get this without incurring huge amounts of vacancy. And in fact, we can give discounts on those other unit types on the street rate to get them in. Therefore, hedging and actually buffering against our occupancy drop. We'll be filling in the other units at a discount, giving rate increases on the units that we know we can, and we'll get move-outs, which we actually want because we want new people to come in at higher rates. That increases what is called our gross revenue potential. So we may have, even if we had lost 20% of people, but if at the new rate, the property's gross revenue potential just went way up and we're making more revenue. So that's a good thing. But taking that profile on those units and looking at it, you can then determine. And all of a sudden, it's not just in the dark throwing a dart. You actually have created charts, data, which we're targeting individual unit sizes. So we're maximizing rate increases and vacancy at the same time, but we do it before we even pull those triggers. Really good data and information that's, pivotal. And that stuff too that you're creating, we don't get that. We can't go pay for the software system that we do use, and we use like revenue management stuff, but we're talking about stuff that we built out and you built out, not we, you, to go to the side of that to run on it. And we had one facility was at our Denver location, and how much, I'm trying to remember how much we figured an increase on that thing would be. It was huge.
It was like $29,000 increase in 1 month.
In 1 month.
Every month.
Every month.
And that's when we went very less aggressive.
Yes. Exactly. That was our less aggressive. So to give you any ideas, you're talking like $300,000 net over a year on the less aggressive one. Oh, a $300,000 net. I mean, even at a 10 cap, that's $3 million. That's a $6 million increase on a 5 cap in a number 1 metro area. And that is where we're predicating our goals and everything. So, all right, we want to increase value and income. Well, we just mapped out exactly how we can do that. $6 million on one facility. And we saw even on that, we could lose literally over 30%, and we're still way up.
Yes.
Now, we don't think we will because, once again, that was the less aggressive one.
Correct,
but the next aggressive one will come after you get the data, and then you can see. So you guys, I hope you see what Maryanne's doing is, first of all, building out that plan off the data she's getting. Then she's moving forward and creating a plan, whether that is through our rate increases based upon vacancy, everything to achieve goals, to increase that. And then we're implementing to get the feedback, and then we keep rolling it out. Yes. And it is a layering, trial and error process. Mm-hmm. And you're doing it predicated on feedback. We did this, didn't work, let's try something new, right? Mm-hmm. And it a lot of people, you first of all treat the units all as one. All 10 by 10s, the exact same thing, all 10%. Or the facility as a whole. Mm-hmm. We're going to give all the tenants a 6% rate increase, right? And what happens is you'll lose the tenants you were going to lose, but then the tenants you weren't going to lose that would have paid twice or 3 times as much, you don't get it. So you actually get the worst of both worlds.
Correct. Mm-hmm. Yeah. And I know that back when I was in multifamily, there was a time that I primarily did like the rental increases, but there was a time that I wasn't doing it for a while and somebody else did, and they did like a 3% throughout. And with multifamily, you lock them in for a year.
Yes.
Worst mistake ever.
Because you can't do anything about it.
You can't do it. Yeah. You can't do anything about it. Yeah. And everything. But that, as you said, that's sensitivity. Like look at each unit type and all and everything. Look at the tenants in those unit types. Yeah. What is the maximum you're giving that one tenant? Like we found some people that were paying like maybe 80% less than the average and all because, you know, maybe they got like the family and friends deal. Who knows how many
Never
years ago.
Never got a rate increase 5 years.
You know, and everything. That person, if you give them like the maximum, they either will pay or will move out. But if they move out, we're not even losing and everything because we can get somebody in without even trying because they're paying too low. Too low, right? And all and everything. So just like looking at each individual and everything and seeing what their rent increase is going to be and all.
And when she says individual, I mean individual. We're looking at individual doors, individual people. Like we actually have spreadsheets where we build them out, and she's looking at it and we're saying, okay, this is where, this is at. And I think that more of that micro approach, everyone should be taking. And once again, not treating it just like real estate, not just stand or walk away. And that's the important difference that you just mentioned. Multifamily versus storage and our abilities. There's just all these levers and things that we can do. And if you're not using them, you're leaving money on the table.
You really are. And then the other thing you touched on a little bit is timeline. And I wanted to stress the importance of making those decisions. We talked about looking at these metrics every week. We're looking at your spreadsheets, we're looking at this data, and then making those decisions, making sure we're on track, off track, building more roadmaps into the future. But it's super important that you guys and that we are looking at these metrics every single week, because by the time you identify the problem, get a solution in place, execute that, send the notices to tenants, do the updates of the facilities, whatever. I mean, you're talking months of time. Yes. And if you don't identify those things quickly and act immediately, you could be way behind.
Way behind. Literally a year behind. Because, I mean, if you have, and we've done this, you can't figure something out for 2-3 months. It's during the busy season. You know something's wrong. By the time you do and can implement it, you're out of the busy season. Mm-hmm. So you just lost the whole busy season. So this weekly approach, it also shows outliers where it's like all of a sudden one number jumped. Mm-hmm. And it was like, whoa, what happened here? Like, and it allows you to get your feedback loops a lot smaller. Mm-hmm. And really that's the key. It's that identification, it's the diagnosing, and then it's the fixing it and doing it quickly. Mm-hmm. And that was the hardest thing for our organization, to be totally honest. Without you, there's so many assets, so many doors. Mm-hmm. It was like we couldn't quickly diagnose those things, and we couldn't find them. By the time we were finding them in the P&L. And that's the worst thing possible. Mm-hmm. You find mistakes in P&L, you're finding it because there's something wrong with the financials, and then you got to go back and start digging into. But you're getting that clear on the back end, right? And so don't let your P&L show you mistakes. You should have your KPIs that show you mistakes before they ever hit the P&L. So, well, this is just mass amounts of incredible information. Everybody, you can go to YouTube, I know we have a whole video where I show the chart on vacancies that you made and how in individual unit sizes and what that looks like. But thank you so much for coming on. We are so happy to have you as part of the team. I mean, it's classic who not how, but really what you do and show. We're very proud of it here.
I love it here too. The team is amazing, and yeah. My daughter, I have to say this. My daughter was like, "Mom, you can't be serious. You enjoy going to work." I said,
yeah, that's a lot of us here.
And storage?
Yeah,
like,
storage
you enjoy storage?
things.
I know, but we like it.
Yeah.
Well, thanks for coming on, and we'll definitely hear from you again.
Thank you. Thank you so much.
Thanks, Maryanne, and thanks, everybody. We'll see you next time.
Thank you.
Awesome. That was wonderful. Thanks, everybody, for listening. Now, if you're like me, which you're listening to this podcast, so you probably are, there just doesn't seem to be enough information. That's why we started our self-storage income community with over 300 members so far that are all doing self-storage. We include all of our webinars about underwriting, finding deals, market analysis, and operating. We include due diligence checklists and our underwriting modeler. So if you want more and you're ready to get started or expand your self-storage investing journey, join today our self-storage income community.